Welcome everyone to Nothing Says Love Like Non-Discrimination, the Rules and Practical Considerations. Thank you all so much for joining us. Our moderator for today's call is Chase Cannon. He will be answering the questions you send through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recordings in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Friday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'd like to introduce our speakers for today's webinar. Joining us today are Patrick Myers, Vice President and Counsel of Benefits Compliance at NFP, and Elizabeth Allen, Vice President and Counsel of Benefits Compliance at NFP. We're very excited to have them speaking with us today. It is my pleasure to hand over the call to our speaker. Beth, the floor is yours.
Thank you so much, Amber, and welcome everyone to Nothing Says Love Like Non-Discrimination, the Rules and Practical Considerations. Obviously, here we are on Valentine's Week, so that is our, message to you all. Glad you're here. We're going to talk about non-discrimination. As always, here's myself, here's Patrick, and we're from the NFP Benefits Compliance team. Obviously, we are not your legal or your tax counsel. We're going to be talking about a lot of tax concepts today, but we're not accountants. And you want to go to your tax counsel for any kind of questions that you might have. All right, so first, I'd like to start off with a poll, okay? And so today we're going to be talking about non-discrimination. And so the question that I would like for you to answer is, do you currently conduct non-discrimination testing on your health plans? And the first answer is we test some benefits every year. The second answer is we're considering implementing testing. And the third answer is we don't currently test. So thank you for kicking that off, Amber, and we'll wait about 30 to 45 seconds to get everyone to answer that. All right, I feel like the Jeopardy tune would be over. Amber, do you want to give us the results on that? All right, so we have 56% of folks who test some benefits every year. We have some who are considering implementing testing, and then we have about 36% of the group who does not currently test. And so that's kind of good information to start off with as we go into kind of our agenda today and what we're going to discuss. And as always, you can feel free to put questions in the Q&A. That's where we're going to want to answer those. Our benefits compliance team members are there to answer those for you. And let's just go ahead and jump into what we're going to talk about today. We're going to be talking about the different IRS non-discrimination rules that might apply to group health and welfare plans, okay? So as a part of that, we're going to talk about Section 125, or the Cafeteria Plan non-discrimination rules, Section 105, which applies to self-funded group health plans. We're going to talk about Section 129, which applies to dependent care assistance programs. And then we're going to talk about Section 79, which imposes non-discrimination rules on group term life. We'll end it out with some takeaways and some resources, and then obviously hope to leave time for your questions at the end. We'll also look and see if there's any questions as we're going on. For each of the IRS sections that you see here, or the IRC questions that you see here, we're going to talk about just the general rules, who is a highly compensated employee or a key employee, red flags to look for, the tests that are basically run on these particular types of benefits, consequences of failure, plus additional thoughts. Now, before we go on to Section 125 specifically, I have a couple of things that I just want to kind of throw in and mention as disclaimers, if you will. The first one is that you'll notice that today we're obviously talking about non-discrimination based on tax concepts. There's also technically non-discrimination based on a health factor, which would fall under HIPAA, or a non-discrimination based on accessing genetic information, which would fall under the Genetic Information Non-Discrimination Act. We're not talking about any of those, right? So all of the non-discrimination topics that we talk about today have to do with the tax advantages that plan sponsors and employees get from sponsoring these plans. I will also mention that you will see us somewhat go back and forth between the concept of a highly compensated employee or you'll see us say highly compensated individual. The IRS did not make this easy for us because these different sections, specifically 125, 105, and 129, kind of use different terms. We mostly see that 125 and 129 will use the term HCE or highly compensated employee, but then sometimes they even throw in some additional terms like highly compensated person, and then you might see where section 105 uses HCI. So just keep in mind, we try to keep those kind of consistent based on which one the law uses, but it's really not that important as much as kind of knowing who those prohibited quote unquote groups are, okay? Now, mind you, we are going to talk about the testing and kind of how the testing works, but we're not probably going to go into as much detail about that. And you don't necessarily have to like memorize how the tests work because your vendors are really going to be doing that testing for you. But kind of the information we share about the testing will allow you to at least understand kind of maybe some red flags for how the test might, be failed. And then finally, I'll mention that, this is not a situation where there's a large group of plans that are exempt from these requirements, right? Technically, we always get the question, is testing required? Technically, testing is not required as much as the requirement is to make sure that your plan is not non-discriminatory, and you don't know whether that's the case unless you actually do the testing. And so we're going to be talking about that testing, and generally these requirements are going to apply to pretty much all plans, right? So we're used to with ERISA, there are exemptions for government plans and for church plans. And so they don't do that kind of stuff. But if you're on the line today and these taxation requirements apply, or if you are a government entity, or if you are even potentially a church entity, then most of these, if not all of these, are going to apply. I do think there's a random exception for churches on the group term life, but for the most part, these are going to be required. And also keep in mind that there's not really any distinction for plans that might be, let's say, nonprofit or feel like the employer doesn't pay taxes. Those employees are likely paying taxes as citizens of the United States. And so these rules are still going to be subject to those nonprofits as well. And so those are kind of just some disclaimers we had on, the topics that we're going to talk about. Now, with that said, I'm going to throw it over to Patrick to start off with section 125, Cafeteria Plan Non-Discrimination.
Thank you, Beth. Welcome, everybody. Thank you for joining us on this topic today. And we're going to start off with a discussion of Section 125, which is the section of the Internal Revenue Code that deals with cafeteria plans. And I reckon most of you, when you're dealing with non-discrimination issues, you're generally dealing with Section 125 non-discrimination issues. Beth, if you can go to the next slide, please. Cafeteria plans, of course, are those plans that allow employees and participants to pay a portion of their premiums on a pre-tax basis. And in order for people to get a tax advantage for doing so, they have to comply with the rules under Section 125, which includes, of course, the non-discrimination rules that we'll be discussing today. It usually includes things like health insurance premiums, health flexible spending arrangements, those DCAPs or the dependent care flexible spending arrangements, health savings accounts, and sometimes short and long-term disabilities, and group term life. So if you're dealing with any of those on a pre-tax basis, you are generally dealing with Section 125. And so these rules will come into play quite often. So if you go to the next slide, please. Now, the general concept here for Section 125, and frankly, it's going to be an operative concept through all the sections we're going to be discussing today, is that plans are prohibited from discriminating in favor of highly compensated employees, which we will call HCEs for the rest of the talk, and key employees, which is a concept that we'll discuss both in this section as well as in Section 79, in terms of eligibility, benefits, and employer contributions. Another way to look at this is that the concept here is that you want to treat all your kids the same. If you don't, or if you vary your benefits, then you're looking at dealing with non-discrimination rules. As long as the variance does not discriminate in favor of HCEs, an employer may vary benefits by bona fide employment classifications under this section. And that includes things such as geographic locations, job title, date of hire. Now, this is likely not going to allow you to create random classes that can be used to segregate one or two people out from the rest of the population. and consider that to be a bona fide employment classification. But there are some classifications that the IRC recognizes as bona fide classifications between which you can vary benefits, provided that those variances don't favor HCEs. Beth, can we get the next slide, please? So under Section 125, an HCE is defined as either an officer of the employer, someone who holds more than 5% of the shares in the employer, or if their salary is greater than $135,000, at least for the year 2022. This amount is indexed by year, so it generally goes up a little bit every year, but for this year, it's $135,000. We go to the next slide, please. So we talked about key employees briefly earlier, and that definition under Section 125 is a person that is a more than 5% shareholder, has a salary greater than $200,000 for this year, and is an owner that owns more than 1% of the employer with compensation greater than $150,000. Now, this really, the key employee concept in Section 125 really comes into play into one of the tests that I will touch on a little bit here a little later. But it's important to keep this in mind. This is one of the concepts that you have to deal with in Section 125. So we can go to the next slide, please. So some red flags to look for to see whether or not non-discrimination could be an issue in a Section 125 plan. Include if your owners or your managers are paying a lower premium contribution than other employees, that's a red flag. Another red flag is that if only executives are eligible for a plan or for a benefit. In addition, if the contributions for HCEs are taken pre-tax, but all others are contributing post-tax, is definitely a potential red flag. And then finally, certain high-level employees who have no or shorter waiting periods than other employees, that's a benefit that could be considered to be discriminatory if it favors HCEs over non-HCEs. So these are the kinds of things you're looking for if you vary benefits across your employees. Next slide, please. So under Section 125, generally speaking, you have three tests. You have an eligibility test, which tests to make sure that a plan doesn't discriminate in favor of HCEs as to eligibility to participate. Now, I want to note here that there are three alternative tests here that can be applied when the tester is determining eligibility. And I want to mention this only because when many of you get tested, the testing vendor will usually provide you with some sort of report that lets you know what kind of tests were used and whether or not the plan failed one or more of those tests. And often you will see when you're talking about an eligibility test under Section 125, you'll see several alternative tests, and you might even see that the employer or the plan has failed one or more of those tests. The thing to keep in mind when you see something like that is not to panic. You only need to pass one of these alternative tests to pass the eligibility tests. And I'll just briefly touch on what those alternative tests are just to be thorough. But again, there's not going to be a test at the end of this. So just to keep these in mind, if you see these reports and you see that one or more of these may have failed. The first alternative test is that the plan actually has to benefit 70% or more of all employees. In other words, 70% or more of all employees must be enrolled in the plan in order to pass the first alternative test. In the second alternative test, 70% or more of all employees must be eligible to participate in the plan. And of those eligible to participate, at least 80% must actually benefit under the plan. And then finally, under the third test, the plan has to be set up so that it benefits a classification of employees that is found by the Secretary of Treasury, that is to say, the federal government, not to be discriminatory in favor of HCEs. And this is known as the reasonable classification test. That one can get really complicated really fast, but the operative concept for our purposes today is that you only need to pass one of these to pass the eligibility test. The second general test that is applied in Section 125 is the contribution and benefits test. And in this test, both HCEs and non-HCEs and any of those dependents must generally be provided with the same benefits. Now, there are two alternative tests here too, and I'll touch on them briefly. But again, the operative concept here is that there are two components to the test. There's facial discrimination and operational discrimination. That is, if the benefits test passes or fails on its face or in operation. And to pass the test as it relates to discrimination on the plan's face, the following has to be true. The employer contribution levels must not favor HCEs. The maximum benefit and employer contribution levels may not vary based on age, compensation, or years of service, and types and amounts of reimbursable medical expenses must not favor HCEs. And again, the waiting period for benefits must be the same for all employees. If those are the kinds of things that the tester will look for when they're doing the contribution and benefits test. Now, the final test I'll touch on for this section is the key employee concentration test. And that's where the key employee concept comes into play. And in this test, the key employees should not receive more than 25% of the aggregate benefits offered through the cafeteria plan. So next slide, please. So what happens if you go through all those tests and they fail? Well, highly compensated employees will lose their favorable tax treatment under Section 125. So any salary reductions that they would have enjoyed under the cafeteria plan will end up being taxable to the highly compensated employees. Now, even if it fails, the HCEs may lose their favorable tax treatment, but non-HCEs will not be affected. So they will still enjoy those tax advantages under the Section 125 cafeteria plan, even if the discrimination tests are failed. Now, the employer is not penalized specifically for this, but they may have to adjust payroll records and W-2s, which of course would be an administrative expense that they would have to deal with if they find that the plan fails the non-discrimination tests. Next slide, please. So here, we'd like to wrap up this section with some additional thoughts on the Section 125 tests and rules. Employers that offer all employees the same opportunity to enroll in the cafeteria plan with the same contributions and benefits are unlikely to fail. That's something to keep in mind when you're looking at these tests to see if you need to go look at the plan to see if you need to test. If you're varying if you're varying benefits in any way, then likely you'll need to test just to absolutely make sure that you don't fail. Now, reverse discrimination is allowed in Section 125 plans, which is to say, if you vary benefits in order to favor non-HCEs, that's fine. It's when you favor HCEs that becomes a problem. So if the benefits vary, but not in favor of non-HCEs, the plan should likely be tested. And sometimes cafeteria plan sponsors offer HCEs 100% employer, fully paid, fully insured health coverage. And because this is not since the executives are not paying for the premiums for that benefit on a pre-tax basis, Section 125 likely does not apply. And since it's a fully insured health cover plan, Section 105, which we'll be discussing here in a moment, that won't apply either. So this is currently an option. Now, it may no longer be an option once ACA non-discrimination regulations come out. And if Section 105, which applies to self-insured plans, if it starts to apply to fully insured plans, then it also would not, this would not be an option. Another thing to keep in mind that as long as it is an option, HCEs cannot pay for any of their coverage pre-tax, not just the coverage that they are getting their 100% employer paid, fully insured health coverage for. So you can't, the dependents, you have to pay for the dependents coverage pre-tax. I'm sorry, you can't pay for the dependents coverage pre-tax, and you can't pay for, contribute to HSAs or FSAs on a pre-tax basis if they're going to enjoy this particular option. Next slide, please.
That's it on Section 125. Thank you, Patrick. Chase, any questions that we got from Q&A that you want to kind of bring up for us to discuss?
Yeah, I guess two kind of themes in the questions. One is speak just a little bit more about what it means to be a bona fide business classification, because we get that question a lot. The concept applies the same when we get into 105 testing, so it's a nice segue, but just what is a bona fide business classification? In other words, upon which lines can I offer different benefits, different contributions, different eligibility? And then the other question is about excludable employees. On some of these tests, you only include those that are actually participating in the plan. And then are there any like buckets of employees that I can just throw out and not include altogether?
Yeah, so Patrick, if you're good, I'll kind of speak to these really quickly. Sure. On the bona fide business class, designation, the IRS did us a favor and kind of threw out some that are common, right? So geography, and someone asked if that's like, down to the state or the city, or does it matter? And it's really just like, okay, are they separate locations, right? They brought up, let's say, job or occupation titles, right? You might have different groups of employees based on kind of what their job is. Likewise, maybe the difference between hourly and salaried. Although with that one, you want to make sure that like that doesn't actually discriminate in favor of highly comped people, because you could have more people who are highly comped in the salary side. And so that might be kind of more of a business class that you need to watch. But I think the point that I usually make about bona fide business classes is that there should be some other non-benefits related reason that you're clumping these people together for the most part, right? Because that's how we know that it's kind of benefits related. That's also how we would say that generally, if you're just picking some random person who gets different terms, that's usually not going to be business related, right? And so you want to be careful, like Patrick said, where you are singling out one or two people and trying to make it seem like there's some bona fide business class, because it's likely that that's not actually legit, okay? That second question, I think, Chase, that we specifically got about kind of who's excluded, and I think I saw somebody in there specifically point to people who are actually not eligible for the Section 125 plan. And so those who are considered self-employed, so partners in a partnership, owners, sole proprietors, and things like that are not going to be eligible for a Section 125 plan anyway, meaning that they cannot pay pre-tax if they're on the benefits. They would not be included in the testing because they can't pay pre-tax, right? And so that is kind of the requirement here. That's going to change for other rules that I'm about to talk about. But keep in mind that if they're not actually participating in the Section 125 plan because they can't, then they're not going to be included in that testing. All right.
Perfect. Yeah, thanks for that.
Sure. So that is Section 125. And as Patrick said, that applies to plans that allow for employees to pay on a pre-tax basis. We're going to switch now to Section 105, which applies to self-funded group health plans. And so the Section 105 rules are going to apply to any basically self-funded health plan. And that's not just the major medical plan that can be self-funded, which I think is what we're all used to, but that's also health reimbursement arrangements and flexible spending accounts. And so these non-discrimination rules are going to apply to all of those different types of self-funded plans, okay? Now, keep in mind that Patrick already mentioned that the ACA technically had a provision that said that they were going to apply Section 105H to fully insured plans. And so that would make it to where, plans that are currently only subject to Section 125 because they pay pre-tax may now be subject to Section 105. Interestingly, though, those were supposed to actually go into effect with the rest of the ACA. But the IRS basically came out and said, you don't really have to comply until we come out with regulations. And they haven't done that yet. And we don't know when or if they will do that. So for now, the ACA kind of provision that would apply Section 105H to fully insured plans is technically not in force. So the general concept behind Section 105 is akin to the concept behind Section 125, and that's that a plan is prohibited from discriminating in favor of highly compensated individuals in terms of eligibility and benefits. As we already mentioned, there can be discrimination based on bona fide employment classifications, as long as it doesn't discriminate in favor of HCIs. And this actually ends up a little bit different with the testing, and I'll talk about that in a minute, based on kind of the idea of what an HCI HCI is, okay? But then we also see kind of specific rules that apply to in the self-funded context that don't apply in the fully insured context, okay? So for example, Section 105 specifically says that self-funded plans cannot discriminate based on years of service, age, or compensation, right? So that's even before we get to this conversation of whether or not the benefits discriminate in favor of HCIs. They cannot discriminate based on years of service, age, or compensation. Now, we often have employers who come to us as far as it pertains to years of service and say, well, can we basically do kind of grandfather people in, right? So it's not so much people who, let's say, have been with the company for 20 years, but let's say we set one date and say anybody who was hired before this date has a certain set of kind of benefits or eligibility that applies to them, and then people who were hired after, some certain dates, have different eligibility or benefits. That's actually okay because it's not actually years of service as much as it's kind of like based on date of hire, if you will. But then, yeah, any other discrimination that we're going to see based on how many years of service someone has or tenure, their age, or their compensation is generally going to be considered discriminatory just out the gate for Section 105. Now, who is an HCI for Section 105? And this was where the definition is a little bit different. It's the 5 highest paid officers. I wish the IRS did a better job of like defining officers for us. But I would assume, I think that most employers look at this as like, your president, your VP, maybe a CFO, and those positions that are very specifically titled at the very top of the company. Another definition of HCI is going to be a more than 10% shareholder. And then that last portion of the HCI definition has to do with the highest paid 25% of employees. And I think that's important because if you consider that Section 125 had a salary threshold of $135,000, I think, this year. This actually rule includes the highest paid 25%. So we're no longer talking about just people who make, that above 6 figures number. We're talking about those who are the highest paid 25% of the group. And so if you have a company that has quite a few, if not the vast majority or all of the employees who don't make that $135,000 number, you're still going to end up with HCIs because the highest paid 25% will fall into that definition for self-funded purposes. So based on that kind of understanding of who the HCIs are for self-funded plans, here are some red flags. If you have an owner and or manager that pays a lower premium contribution than other employees, and really a lot of this is going to look similar to Section 125, right? Just with a different definition of who an HCI is. If you have only executives that are eligible for a plan, that's going to be a problem. And we talked about the fact that there was somewhat of a loophole in Section 125, where if the employer paid 100% for those people because it was fully insured, it wouldn't be an issue. But this kind of is going to make it clear it's an issue because if those executives are on a self-funded plan, you kind of lose that loophole. Obviously, if highly compensated individuals receive a higher HRA or FSA contribution from the employer, that would likely cause the plan to fail. If certain high-level employees have no or shorter waiting periods, and I'm going to talk about that as well. And then finally, employees that pay a lower premium contribution based on years of service, that's just going to kind of violate the rules altogether, okay? And so when we start to discuss the tests, the tests are pretty much the same as what we got under the Section 125 test. And so on the eligibility test, it's that same 3 alternate tests. One was 70% or more of all employees, or 70% or more are eligible, but then 80% actually benefit under the plan. And then there was the reasonable classification test. So for purposes of Section 105, that eligibility test is the same as we saw under Section 125. Likewise, the benefits test here, although it's not called a contribution and benefits test here, it's just the benefits test. It operates similarly with the 2 alternate tests. The difference here, I think, and one of the things that we see specifically under the benefits test for Section 105 is that Section 105 doesn't actually allow for disparate waiting periods for self-funded plans. And so the way the regs are written, it makes it seem like you could not, let's say, have a different waiting period under a self-insured plan for managers, let's say, than you do for rank and file employees. And so that's sometimes a design we see that is technically not compliant with Section 105. Now, what are the consequences of failure? And they're somewhat similar to Section 125, right? Because all of these plans are going to end up with basically tax advantages that are lost. But it's slightly different in how that is calculated, okay? And so with self-funded plans, those highly compensated employees are going to lose their favorable tax treatment, but the calculation is based on excess reimbursements. So it's kind of like the idea that these HCIs got higher reimbursements, let's say, than the other employees got under the plan. And that calculation is going to be different based on whether or not the plan fails the eligibility test. And that's really based on like this fraction of kind of who accessed the benefits under the plan and how much of those benefits went to HCEs versus non-HCEs. And then it's going to create like a fraction. And then on the other side, with the benefits test, that's really the total reimbursement that the HCI received that is going to now be taxed to them as an excess reimbursement. Now, again, we've already mentioned that the ACA provision says that Section 105 will one time apply and one point apply to Section 125, or not Section 125, to fully insured plans. And if that does ever take place, then there was a $100 per day per affected individual penalty technically. But like I said, that provision is on hold. And then, as always, non-HCIs are not affected by discriminatory plan design. And so if a Section 105 plan fails non-discrimination testing, then those HCIs are going to have their tax advantages changed, and the non-HCIs are going to kind of just continue on as normal. So some additional thoughts, and I kind of talked about this already when we talked about the top 25% rule. Section 105 is going to be a bit easier to fail if there's any variation between higher and lower paid employees, because of the fact that it's not just those people making above that $135,000 threshold and officers, it's also the top 25% of wage earners. And so that means even if you have a company where none of your employees make one of those higher amounts or in the six figures, you still could potentially fail this test. And so you want to make sure that you kind of understand that that's still a possibility because of the way that the Section 105 test is designed. As Patrick mentioned, reverse discrimination is still allowed. So if it's found that the plan is basically discriminating in favor of the non-highly compensated individuals, then that's not going to be an issue under the non-discrimination rules. One thing that we do find often is that employers don't realize that HRAs are also subject to these rules. And so you want to make sure that the way that the HRAs are designed does not also, run afoul of these rules. Sometimes we'll specifically see employers who only offer HRA reimbursements to, the highest of the high employees. And then that's definitely going to fail the eligibility test because it's not even available to the non-highly comps. And here it is, this whole reimbursement arrangement. And then finally, one slight exception that we do see that some employers take advantage of is the fact that there are certain executive physical programs that may be allowed if they meet certain requirements, right? So some companies do have a need to, let's say, have their highest paid employees and their employees that are kind of very important to, obviously, the company's, direction, to have physicals done just so that they know kind of what the health looks like for those executives. And so those can be reimbursed or provided to employees or executives generally without there being tax consequences, as long as certain rules are met. And so that is Section 105 and kind of what we wanted to share. Chase, any questions that you want to highlight after the discussion of Section 105?
Yeah, thanks to both of you. It's a great recap and instruction guide on 105. So one question on the types of plans. We had 2 or 3 questions come in asking about level funded plans. Self-insured, subject to 105. What are your thoughts there?
Patrick, you want to take that?
Level funded plans are considered self-insured plans, at least for this purpose. So 105 would apply to level funded plans.
Yeah, and I think that's the hard part because often level funded plans are sold kind of like they're similar to fully insured plans, but the insurers who sell them don't always kind of make it very clear that under most of the laws that you're dealing with for benefits, if not all, a level funded plan is considered a self-funded plan. So you do want to watch out for that. That's a great question.
Great. What if I'm an employer, I'm offering the same level of benefits, the same eligibility, same waiting period, same contributions to all employees? Is there any need to do the non-discrimination testing in that scenario?
Yeah, so that's, that's an interesting concept. And I think we kind of alluded to that from the beginning because of the idea that the law doesn't actually require the testing as much as the law requires you not to be discriminatory. I would say if you don't vary anything, then it would seem like less likely that you would fail, right? But we cannot say for certain that that is not the case. These tests, a couple of them actually kind of include, let's say, utilization type elements to it. I know, for example, with Section 125, on that key employee concentration test, there's kind of an element that has to do with, whether or not the keys use the benefits more than everybody else. And so there's kind of some of those little quirky things that you may not know unless you actually test. But we do generally believe if kind of everything is offered to everybody on the exact same basis, it's not going to fail. Okay. Patrick's about to talk about decaps though, and that's actually an exception to everything I just said. Okay. And so keep in mind that that's going to depend on the test.
Yeah, totally agree. We'll hang tight for Patrick's decap analysis, which definitely gets to that. But one other question,
Sure.
What about union employees or collectively bargained employees? Are they
Right.
generally good?
Great question. Union or collectively bargained employees are usually left out of testing for a couple of reasons. The first reason is generally that they might be on a different plan, but if they are on the plan, then generally they wouldn't necessarily be included because of the fact that their benefits are collectively bargained, right? So like they agree to certain benefits and let's say contribution levels with the union. And so that will be generally why they would not necessarily be included in testing. But I want to say that there's at least one exception to that, where if they are included on the plan, they would be included in testing. Jailbreaking, I feel like you know what this is off the top of your head. So just chime in, or I don't know, put it in the chat and I'll follow back up on that. Good questions. Patrick,
Yeah.
you want to talk about decaps?
Sure. Dependent care assistance program non-discrimination rules are a bit of an odd duck because even though most employees and participants make pre-tax contributions to their dependent care flexible spending account, their actual non-discrimination rules are not found under Section 125. They've got their own little code, Section 129, that deals with non-discrimination issues with decaps. Go to the next slide, please. With the decap, you, of course, get reimbursements from you contribute into a decap or a dependent care flexible spending arrangement. I'm just going to call them decaps going forward. Reimbursements from the decaps are for dependent care, and direct payments of dependent care expenses by the employer and the fair market value of any on-site dependent care services that are not paid for by the employee on an after-tax basis. So if you've got a program that provides those benefits, then they're likely subject to Section 129 and the rules that we'll be discussing in a little more detail here in the next few minutes. So if we can get the next slide, please. So the operative concept here is that decaps may not favor HCEs, highly compensated employees, in terms of either eligibility or contributions or benefits. Now, something to keep in mind here, and I want to flag this a couple of times, that average benefits provided to non-HCEs must be at least 55% of the average benefits provided to HCEs. I point this out now, and I'll point it out again later, because this is a test that decaps often trip up on this test. They often fail to meet this requirement. So it's an important requirement to keep in mind when you're looking at whether or not the decap benefit is discriminatory. Next slide, please. So who is an HCE under Section 129? Very similarly to 125, if you hold more than 5% of the shares in the employer, you will be an HCE for this purpose. In addition, if you have a salary greater than $135,000, at least for 2022, you're also an HCE. So the plan cannot favor these individuals more than non-HCEs. Next slide, please. What are some red flags that will tell you or indicate to you that there may be a problem in the Section 129 plan or a benefit? Well, certain categories of employees, such as, for instance, part-time or hourly are excluded. That would be a problem or a potential problem. Only available to employees of one member of a control group. And average benefits provided to non-HCEs are not at least 55% of the average benefits provided to HCEs. Again, I wanted to put a pin on that one because, again, that's the one that's most likely to fail. So that's something to keep in mind. And I'll get into why here in a moment. Next slide, please. So now we're going to talk about the tests. The tests here include an eligibility test in which the plan must not discriminate in favor of HCEs as to the eligibility to participate. A plan that is offered on the same terms to all employees will satisfy this test. Now, a thing I want to point out for the eligibility test is that if some employee classifications are not eligible to participate, then the plan must be set up to benefit a classification of employees that is found by the federal government not to discriminate in favor of HCEs. And now there's a two-step non-discriminatory classification test for this. And the first step requires that classification of employees is based on a bona fide employment classification consistent with the employer's usual business practice. Then the second step requires that the classification of employees also be considered non-discriminatory based on a certain safe harbor percentage rate described in IRS regulations. Now, obviously that gets complicated pretty fast, but these are the things to keep in mind when you're looking at eligibility in a DCAP benefit. The second test is a benefits and contributions test. And in this test, both HCEs and non-HCEs must generally be provided with the same benefits. This is generally a facts and circumstances test, and it considers whether HCEs receive different or greater benefits or pay less for the same benefits than others. The majority of DCAPs are funded solely through employee salary reductions and are provided on the same terms to all eligible employees, so they may likely pass this test. However, if one member of a controlled group makes separate employer contributions to its DCAP, that is, seed money or matching contributions or employer paid on-site dependent care services, and others do not, the plan could potentially fail this test. And when I mean controlled group, I mean a member of a group of companies that are commonly owned by someone, which is a determination that usually has to be done by legal counsel or tax advisor. Now, another test that is focused on in this section is the more than 5% owner concentration test. And in this test, the principal shareholders and owners of the employer should not disproportionately receive DCAP benefits. And the final test in this section is the 55% average benefits test. And again, this is the test I've been alluding to in this portion of the presentation. And that is the average DCAP benefits provided to HCEs must be at least 55% of the average benefits provided to HCEs. On average, for every $100 reimbursed to HCEs, at least $55 in benefits must be reimbursed to non-HCEs. Now, the reason why that DCAP benefits may fail this test is because HCEs may be more likely to participate in a DCAP than non-HCEs. So they're the ones who benefit the most from the test, from the benefit. And so it's not unusual for the plan to fail this test. And if you think about it, it kind of makes sense because under most DCAPs, the participant who is not only putting in money on a pre-tax basis into the flexible spending plan, but they're usually paying for the expense up front and getting reimbursed later. So you can look at it as somebody's paying that out twice and getting reimbursed once. And so unless you're an HCE, you may not, a participant may not feel that is something that they can afford to do, at least in the short term. So mostly the people who benefit from this DCAP are people who feel they can make those kinds of outlays. And so they're the ones who benefit. Therefore, that's why they tend to fail this particular test. Next slide, please. So what happens if you fail the tests? Well, DCAP reimbursements to those HCEs become taxable. Now, much like the other sections that we've discussed, if you are a non-HCE, you will not be affected by a determination that the benefit is discriminatory. They still qualify for all the tax advantages associated with the DCAP. And also it should be pointed out that there are no monetary penalties for the employer. The costs are going to be borne by those HCEs. Next slide, please. So finally, we have some additional thoughts on the DCAP non-discrimination. It's recommended that the DCAPs be tested at the beginning of the plan year and then again mid-year. This is so that if you find any discriminatory issues in the plan, that they can be addressed and dealt with before the end of the plan year when it would be too late. A discriminatory DCAP can be fixed if it's discovered and corrected before the plan year end. And this often involves adjusting HCE contributions to DCAPs. It can get a little tricky though. So that's one of the reasons why we recommend that the tests be done at the beginning and then mid-year so that some of these issues can be worked out before it's too late. Some employers choose to avoid DCAP non-discrimination issues by plan design. For instance, limiting HCE contributions or eligibility. And effective HCEs can still claim a child care tax credit even if they participate in the DCAP, depending on their tax situation though. So HCEs will need to consult with their own tax advisors when figuring out if they qualify for the child care tax credit and how that should be applied. So that wraps up our discussion on section 129. Are there any questions?
Yeah, so one question that came out in was on our red flag slide. I think we said one red flag was if the employer excludes certain categories of employees, and including part-timers and hourlies. Are we saying in that slide that employers have to include part-time employees or hourly employees? Like, what are the limits on what employers can do for a DCAP eligibility?
I believe the answer to that question probably can be found in the when we were talking about the eligibility tests. There are certain classifications that are found by the federal government not to be discriminatory. If the part-time or hourly fits one of those classifications, then likely that will not be discriminatory. If that answers the question.
Yeah, I think so. I think they're just the question is more. I mean, you answered it, but just to say it more explicitly, like you don't have to include part-timers in eligibility, but you still have to satisfy the non-discrimination test. And one thing that can affect that, right, is if you are limiting employees that can participate who may be non-highly compensated, that might impact the testing, particularly the 55% benefits. In other words, the more non-highly comped you can get to participate, the more likely you are to be able to pass that test.
Exactly.
That's another strategy that we see sometimes is, we talk about DCAP DCAP plan design by limiting HCE contributions or eligibility, but you could also do the other way, just encourage and make it easier for non-highly comped, raise awareness, do more education to try and get more non-highly comped in. Of course, ultimately, it's just a cost call for any employee, whether they A, have dependents that they need this for, and B, whether they have the discretionary income to put towards a DCAP. But
that's right.
One way to help out.
That's right. If you wanted to exclude some classification of employees, just be prepared to really dig into the IRS regulations.
Right. Yeah.
Go ahead. Sorry, Chase.
That's all. Go ahead.
No, and I was just going to say, Jill came back, thank you, with the response about that collectively bargained question. Someone asked if collectively bargained employees are included in testing, and the tests treat those differently. So for example, under section 125, collectively bargained employees are automatically separated for testing, so they're not included in testing. But on section 105, you can only exclude them from testing if they're not actually eligible to participate. So those are two different rules about even kind of who you have to include in testing. And that's why it's important to work with your vendors on these different types of plans, just to make sure that you understand kind of what the requirements are and what the nuances can be. So thank you for checking on that for me, Jill. So we're going to kind of end out, I guess, with the last type of, non-discrimination that you want to avoid. And that is with group term life insurance. And we see, I think, a lot of misinformation with this one specifically. First, it's important to note that these non-discrimination rules are going to apply to employer-provided group term life insurance. And I put that in parentheses, the employer provided, not in parentheses, but in quotes, because a lot of people look at that phrase and think that it means employer paid. And that's actually not what it means. And so even if you have, for example, supplemental life or voluntary life or whatever you call anything above basic life that is paid for by the employees, then that's also going to kind of be worked into these rules. And so you want to be careful that you're not saying, well, everybody gets the same basic amount. It's this voluntary amount that everybody doesn't have access to. That's probably going to be an issue. Okay. And basically, the non-discrimination rules that we see from Section 79 are going to make it to where the cost of the first $50,000 of group term life insurance is not includable in the gross income of participants. Now, the rules here are going to switch a little bit because we're not really worried about HCEs or HCIs as much as we're looking at key employees. And group term life insurance cannot favor key employees in terms of eligibility or contributions or benefits. And you're going to keep on seeing that eligibility, contributions, or benefits because the IRS kind of just has the same concepts. And so, for example, the definition of a key employee is going to be a more than 5% shareholder, salary greater than $200,000, so that's higher than that $135,000 threshold that we've seen before, as well as more than 1% owners with compensation greater than $150,000. So again, this is not going to be all of your employees. This literally is going to be kind of the top employees at your company. Likewise, red flags are similar. If only keys can participate in the group term life, that would probably be an issue, okay? And I'm going to put like an asterisk there because I think we got a question that I'll address really quickly in a second. Also, if keys receive more benefits, so let's say, for example, everybody can access $100,000 of benefit and you allow for keys to access $500,000 worth of benefit, that's probably going to be a red flag, okay? Now, mind you, I said that there's kind of a caveat there where I said that it might be a red flag that only keys can participate. Someone asked about if you have certain executive life insurance arrangements, or let's say life insurance arrangements on just, your higher up employees. Sometimes we'll see these generally where they're going to fall outside of Section 79 because they're not necessarily group term life. So kind of to back up to the rules of group term life, there's like specific rules about kind of how many participants have to be eligible for this and what actually constitutes group term life. And if you're looking at specifically kind of executive-based products, they might not actually even fall under Section 79 and would have different rules and requirements. So keep in mind that some of you might actually have life insurance or even COLI or BOLI that apply, or excuse me, company-owned life insurance or business-owned life insurance that applies to those executive employees that's not going to fall under this section. Now, again, the tests are the same, not exactly the same, slightly different, but it's still this idea of eligibility test and a benefits test. They can't discriminate based on eligibility for keys, and there's 4 alternative tests there. And these tests are slightly different, but kind of include at least 1 or 2 of the same tests, right? So there's a cafeteria plan piggyback test that basically says that if the group term life insurance plan doesn't discriminate as part of, let's say, the cafeteria plan rules, because it is included in the cafeteria plan, then it wouldn't fail, or it wouldn't fail eligibility. There's a 70% test similar to Section 125 and 105. There's an 85% test if at least 85% of all employees who are participants under the plan are non-keys. And then there's the reasonable classification test, which we've also talked about. Likewise, there's a benefits test, right? So that the plan cannot discriminate in favor of keys as to benefits. And basically, you're just going to want to make sure that all the benefits available to the participants who are keys are available to all other participants. And we see a couple of safe harbors there. Basically, if there is a fixed percentage of compensation that is available to people in life insurance, so this is usually your 1 times salary, then that's going to be a safe harbor that's automatically going to pass the benefits test, right? There's also another rate group safe harbor. And that's where the employer basically applies the eligibility test to each group of employees that has a key employee and all the other employees that receive coverage. And that's greater than or equal to the keys coverage. And so that's a little bit harder test to kind of follow. But the idea is that there's a couple different ways that you can satisfy this test. Now, what happens if the Section 79 or the group term life plan fails non-discrimination testing? In that case, key employees are going to lose the benefits of the exclusion for the first $50,000. And so they're going to pay for that cost of the first $50,000, and that will be taxed. In addition, they're going to have imputed income that's equal to the greater of the Table 1 value of all of the key employers' employer-provided group term life insurance coverage, or the actual cost of that coverage. And so there's kind of some additional taxation there that goes beyond just this idea of how much they might have, gotten withheld as far as taxes on that first $50,000. And then finally, the first $50,000 of group term life insurance coverage is not going to be includable in the gross income of non-keys, even if the plan does fail non-discrimination. And that, again, matches with everything else we've talked about today. So some additional thoughts, first, kind of as was given in those kind of safe harbors, group term life can be designed into being non-discriminatory, right? So if you have the same multiple of salary for everybody, or the same exact amount, let's say you have the same flat amount, $50,000 straight up to everyone, then that is generally not going to be non-discriminatory, and you can see that on its face. But it's important to note that there's not really an exception for just one or two keys, right? So if the idea is that, okay, you just have one person like the CEO who receives 2 times salary while everyone else receives 1 time salary, then that's not going to pass likely, because there isn't just kind of some de minimis or, oh, you didn't do, only certain keys and not so many. There's no kind of loophole like that. And then finally, the employer paying for the entirety of the Key's life insurance policy is likely going to fail the benefits test as well. So if you have an employer who says, okay, everybody else has to pay for their life insurance, but you executives, we pay it all, then that's likely going to fail the test and be something that you want to look out for. Okay. Any questions just real quickly in like a minute, Chase, on non-discrimination testing for a group term life?
Yeah, I don't know how much time we have, but there's one in there now that says this applies to both voluntary and group paid term life. So just that, I think another one was if you're paying supplemental life on an after-tax basis, is that subject to it? So
great. Yeah, great. And those are good questions. And so the thing is that, yes, these rules are going to apply to both voluntary and group term life. That's why I talked about the fact that employer provided coverage, I put it in quotes, because that definition doesn't actually lend itself to just the employer paid portion or the basic. It also in kind of lends itself to insurance that's provided through the employer, right? You wouldn't get this insurance if you didn't work for this employer. And so it's considered employer provided. Now, as it pertains to kind of what the taxation looks like on that voluntary life, when it is taken out after taxes, and this is not really a non-discrimination issue as much as it's an issue of taxation, when it's taken out on a post-tax basis, then that's usually going to be used to limit your imputed income exposure. And that's a totally different kind of harder conversation. You might have heard of concepts like straddling the Table 1 or the Table 1. And that's kind of a different discussion that has to do with the taxation of the benefit itself. And so that's a different concept than non-discrimination, okay? But keep in mind that when it comes to kind of this discrimination topic, again, if you allow for that $50,000 might just be the employer portion, but if you allow for keys to have up to $250,000 of voluntary and regular non-keys can only get up to $50,000 of voluntary, then that's also going to be discriminatory, okay? So that's a great question, Chase. So to end us out today, just for some quick takeaways, we've already talked about this. There's not necessarily going to be a requirement to report non-discrimination testing results, but once employers do find that there is an issue with testing or they fail, then they might have to actually do some wage and employment tax reporting that, would reflect the fact that they failed testing. Again, as Patrick mentioned a couple times, specifically with the DCAP, a plan can't make corrections to reduce the adverse impact once the plan year has ended. So we really need that to be done before the end of the plan year. Again, if this ever happens and there is ever an IRS audit on your health plan, then you're going to want to show that the plan is not discriminatory. And then also keep in mind that this is not something that insurance carriers really, pay attention to, right? So like you could have a discriminatory design and the insurer will never mention it. The insurer or ASO will never mention it. So you're really going to want to stay on top of that yourself. And so just finally, we do have 3 white papers that I wanted to mention, and you can ask your advisor for one of these papers on different non-discrimination topics. And so you see one on section 105 and 125, as well as one on section 129, which applies to DCAPs. And then we have a quick reference chart that just talks about the rules for each of the different types of benefits that we talked about today. So ask your advisors for those. And I think we are at time. Thank you everyone for coming. And thank you, Chase, for moderating. I'll send it back over to you, Amber.
Thank you, Beth and Patrick, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We will be sharing the recordings in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Friday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete this survey as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you everyone for joining us and have a great day.